Welcome back to the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamon. This is episode 79, and today we've got some exciting updates to share with you. We'll be diving into the latest developments in the real estate market, including some eye-popping numbers and intriguing trends. Let's get started. How much is all of Ontario's real estate worth? According to the Municipal Property Assessment Corporation, the total value is now estimated at a staggering $3.14 trillion. That's right, $3.14 trillion. This is up from their tally of $42 billion just a year ago. It's an incredible leap that highlights the robust nature of Ontario's real estate market. One of the key contributors to this massive valuation is the new construction happening across the province. Take, for example, the new developments at sites like 407 Dundas Street West in Oakville. These projects are not just adding new housing options, but are also significantly contributing to the overall market value. Toronto, in particular, has seen a notable rise in property values, with the Municipal Property Assessment Corporation estimating the city's real estate worth at $993 billion. This increase is a testament to the ongoing demand and investment in the city, despite various market challenges. The rise in property values across Ontario is not just a statistic, it has real-world implications. For homeowners, this could mean increased equity and better financial stability. For prospective buyers, however, it could signal higher entry costs and the need for more robust financial planning. It's also worth noting that this valuation comes at a time when the real estate market is facing various pressures, including interest rate fluctuations and economic uncertainties. Yet the fact that Ontario's real estate market continues to grow in value speaks volumes about its resilience and attractiveness to both local and international investors. So, what does this mean for you? Whether you're a homeowner, a prospective buyer, or an investor, staying informed about these market trends is crucial. The current valuation of $3.14 trillion is not just a number. It's a reflection of the opportunities and challenges that lie ahead. The real estate industry in Canada has welcomed the latest interest rate cut by the Bank of Canada, but many are hoping for even more reductions throughout the rest of 2024. After announcing its first cut in 4 years last month, the Bank of Canada lowered its overnight lending rate by another 25 basis points to 4.5% on Wednesday. The trend-setting rate had hit a 22-year high of 5% in June 2023. According to the central bank's statement, the decision to reduce the policy interest rate was influenced by easing broad price pressures and an expectation that inflation will move closer to 2%. The bank noted that ongoing excess supply is lowering inflationary pressures, although price pressures in some key areas, like shelter and other services, are still holding inflation up. The Governing Council is carefully assessing these opposing forces on inflation. This move is being closely watched by other countries, including the United States and the United Kingdom, where the question of interest rate cuts remains one of the biggest financial concerns. In the US, economists expect the central bank to cut interest rates later this year, and similar expectations are growing in the UK as well. In Canada, the next rate announcement is scheduled for September 4th. The central bank's statement also referenced the housing market, which could further fuel hopes for additional rate cuts. The bank noted that household spending, including consumer purchases and housing, has been weak. Karen Yulevsky, the chief operating officer of Royal LePage Real Estate Services Limited, expressed optimism about the latest interest rate cut. She stated that their research shows many prospective buyers have been waiting for a concrete signal from the Bank of Canada that the economy is moving in the right direction. According to Yulevsky, a second cut to the overnight lending rate indicates just that, and with mortgage qualification thresholds continuing to come down, sidelined buyers may gain the confidence they need to return to the housing market. Yulevsky added that this could prompt a slight boost in activity in the short term, followed by more robust buyer demand in the fall. She also mentioned that some much-needed inventory has been building in major markets over the last few months, giving buyers more options. In addition to lower rates, this may encourage more buyers to re-enter the market in the near future. Real estate firm Marcus & Millichap expects additional cuts to stimulate home buyer demand throughout the rest of 2024, pointing to a consensus among economists that rates could reach 3% by the end of 2025. This would coincide with falling residential mortgage rates, alleviating some barriers to home ownership. Potential buyers currently renting may seek ownership opportunities as housing costs ease, which could mitigate some pressure on Canada's apartment rental market. However, Marcus and Millichap also noted that with Canada at about half of the 500,000 annual pace needed to restore affordability by 2030, action beyond interest rate cuts is necessary. They emphasized the need for measures to boost housing supply and affordability across the country. Central Bank Governor Tiff Macklem did not provide specific guidance on when the next rate cut would occur, but he made it clear that Wednesday's reduction would not be the last for 2024. He stated that further cuts are reasonable to expect if inflation continues to evolve in line with their forecasts, but emphasized that the bank would take it one decision at a time. Economists at the Canada Imperial Bank of Commerce noted Macklem's comments and predicted 2 additional rate cuts in September and October, which would bring the overnight rate down to 4% by the end of the year. Doug Porter, chief economist with the Bank of Montreal, also suggested that another rate cut in September is now more likely. Carolyn Rogers, the senior deputy governor of the Bank of Canada, highlighted that housing is sensitive to interest rates as well as to population growth and other factors. She pointed out that Canada's housing imbalance is a structural issue and cannot be fixed solely through interest rate changes. Marcus and Millichap argued that the central bank could have cut rates more deeply, stating that record-high population growth has masked weaknesses in per capita output. They noted that changes in Canada's immigration policy, which limit the temporary resident population, could make these weaknesses more visible, driving down GDP and price growth. The firm also mentioned that rate decisions in the United States could influence Canada's actions. They pointed out that a rate cut by the Federal Reserve, which is likely in September, could further support the Bank of Canada's easing path. For commercial real estate, Marcus and Millichap indicated that lower interest rates would boost consumer spending, which would likely become more visible near the end of this year and into 2025. They also believe that lower rates will lead to a recovery in the single-family market, facilitating the transition from renting to homeownership. Combined with lower population growth, this should provide some relief for renters in the multifamily market. However, with completions running below expectations so far this year, the apartment vacancy rate will likely remain low across Canada in 2024. Mark Feeder, principal and president of Avison Young in Canada, said the latest rate reduction would positively affect investor sentiment. He noted that commercial real estate return metrics are improving compared to other asset classes, and he expects this to further fuel investor appetite and capital allocation into property. Feeder added that the recent rate drops show the Bank of Canada's confidence in the inflation data and reinforce the shift into a different interest rate regime. He believes that this will positively impact the real estate market by improving investor sentiment and encouraging more investment into the sector. The Bank of Canada's recent rate cut was expected to boost the housing market, but the country's largest real estate board said existing home and condominium sales activity remains mostly on hold as buyers wait for more reductions. The Greater Toronto Area saw 6,813 home sales in its systems in June, a 16.4% drop compared to 7,429 sales reported in June 2023, the Toronto Regional Real Estate Board said. New listings rose to 17,964, a year-over-year increase of 12.3%. The average selling price of $1,162 to $167 was down by 1.6% from a year ago, according to the Toronto Regional Real Estate Board. The Toronto Regional Real Estate Board, or TRREB, said the central bank must repeat its June decision to cut its overnight lending rate. In fact, the board said that several reductions probably will be needed before sales volume rebounds. The Bank of Canada's rate cut last month provided some initial relief for homeowners and home buyers, said Jennifer Pierce, president of TREB, in a statement. However, the June sales results suggest that most home buyers will require multiple rate cuts before they move off the sidelines. Once home sales in Greater Toronto gain momentum, an ample number of homes on the market should ensure pricing does not jump, the board said. The GTA housing market is currently well supplied. Recent home buyers have benefited from substantial choice and therefore negotiating power on price, said Jason Mercer, chief market analyst with the board, in a commentary. Moving forward, As sales pick up alongside lower borrowing costs, elevated inventory levels will help mitigate against a quick run-up in selling prices. Calgary also saw a significant drop in home sales in June, as sales tumbled 12.8% from the same month in 2023, while new listings decreased by 3.6% and inventory rose by 9.2%, according to new numbers from the Calgary Real Estate Board. Condo sales in Calgary were down 8% for June, as properties priced under $300,000 were scarce. The board blamed a shortage of affordable homes across all residential property types. The pullback in sales reflects supply challenges in the lower price ranges, ultimately limiting sales activity, Anne-Marie Lurie, the organization's chief economist, said in a statement. Despite the decline, 40% of the homes sold went for over the asking price, and the unadjusted benchmark home price rose 9% over last June to $608,000, according to the board. The biggest increases were seen in the northeast and east sections of Calgary. The numbers come in the midst of a population surge in Alberta's biggest city. Calgary's 5.9% population growth between 2022 and 2023 was the highest of any of Canada's 6 metropolitan areas, with a population of over 1 million, according to recent Statistics Canada data. However, its 8.1% unemployment rate remains one of Canada's highest, although it is partly explained by the 73% labor participation rate, Canada's highest. In Canada's most expensive city for housing, the Greater Vancouver Realtors said the area has become a buyer's market, with inventory continuing to accumulate to levels not seen since the spring of 2019. The organization said this week, June sales in the region were 24/18, a 19.1% decrease from the 2,988 sales recorded a year earlier. The sales numbers were 23.6% below the 10-year seasonal average. The June data continued a trend we've been watching, where buyers appear hesitant to transact in volumes we consider typical for this time of year, while sellers remain keen to bring their properties to market. Andrew Liss, Director of Economics and Data Analytics for the Greater Vancouver Realtors, said in a commentary. This dynamic is bringing inventory levels up to a healthy range not seen since before the pandemic. This trend is providing buyers more selection to choose from and driving all market segments toward balanced conditions. Like Toronto Realtors, Vancouver agents are hopeful the Bank of Canada cuts its interest rate again. The central bank is set to release its next announcement on July 24th. This is yet another factor tilting the market in favor of buyers, even if the boost to affordability is modest, said Liss about a potential rate cut. But June's lower-than-normal transaction volumes suggest many buyers remain hesitant, which has allowed inventory to accumulate and has kept a lid on upward price pressure across market segments. The group's composite benchmark price for all residential properties in Metro Vancouver is currently $1,270,100, a 0.5% increase from a year ago and a 0.4% decrease compared to May 2024. Montreal, Canada's second-largest city, proved to be a bright spot in June when the greater metropolitan area saw a 6.4% increase in residential sales in the greater metropolitan area over the same month last year, according to the Quebec Professional Association of Real Estate Brokers. Meanwhile, the Royal Bank of Canada issued a report Thursday that suggested housing has a long way to reach affordability but is headed in the right direction, with rate cuts driving that movement. We think ownership costs have room to fall further in the period ahead. In June, the Bank of Canada initiated what we expect will amount to a full 2 percentage point cut in its policy rate to 3% by the end of 2025, which will bring down long-term rates as well, but to a lesser extent, the bank said in a commentary. Buying a first home is about to get a little bit easier, according to the federal government. On September 16, 2024, the Liberals announced significant mortgage reforms aimed at making homeownership more affordable and within reach for younger generations. Dubbed the most significant mortgage reform in decades by the Feds, Liberal Finance Minister Chrystia Freeland announced 2 changes to Canada's mortgage rules, increasing the $1 million price cap for insured mortgages to $1.5 million. Previously, any house over $1 million was not eligible for mortgage default insurance and therefore required a 20% minimum down payment. expanding eligibility for 30-year mortgage amortizations to all first-time home buyers and all buyers of new builds. Previously, only first-time home buyers of new builds were eligible for a 30-year amortization. Both policy changes come into effect on December 15, 2024, and further details will be announced in the coming weeks. Let's delve into the first major change, increasing the $1 million price cap for insured mortgages to $1.5 million. This is a substantial shift. By raising the limit to $1.5 million, effective December 15, 2024, the Government of Canada is bringing the mortgage default insurance program in line with current housing market realities. This change will enable more Canadians to qualify for a mortgage with a down payment that is less than 20% and expand access to the cost savings and security that comes with mortgage loan insurance. When you purchase a home, you are required to make a down payment. The minimum down payment required is based on the property's purchase price. Under the current rules, the minimum down payment is as follows. For homes costing $500,000 or less, the minimum down payment is 5%. For homes priced between $500,000 to $999,999, the minimum down payment is 5% on the first $500,000 and 10% on the remainder. For homes priced at $1 million or more, the minimum down payment is 20%. If your down payment is less than 20% of the purchase price, you are required to get mortgage default insurance that covers your lender in case you can't make your payments. This makes your mortgage a high ratio or insured mortgage. Mortgage rates for insured mortgages are typically lower than uninsured mortgages because they are less risky for the lender. However, presently homes over $1 million are not eligible for mortgage default insurance, and borrowers must make a 20% down payment. The difference in the down payment requirement is staggering. Under the current rules, assuming a 25-year amortization, here is the difference between a home below and above the current mortgage cap. For a home priced at $995,000, the minimum down payment would be $74,500 compared to $200,000 for a $1 million home. As of December 15, 2024, the new minimum down payment cap will be increased to $1.5 million, meaning homebuyers will qualify for an insured mortgage up to that amount. It has not yet been announced if borrowers will still pay 10% on any portion between $500,000 and $1,499,999. This policy change has several benefits. Borrowers in expensive markets such as Toronto and Vancouver, where home prices are typically over $1 million, will now have access to insured mortgages. Insured mortgages offer lower interest rates than uninsured mortgages, which reduces the threshold for the mortgage stress test. Lower mortgage rates mean lower monthly payments, making it easier for buyers to enter the market. Now let's talk about the second major change, expanding eligibility for 30-year mortgage amortizations. Given that inflation and interest rates have fallen, the government is expanding access to lower monthly mortgage payments to all first-time home buyers and to all buyers of new builds, effective December 15, 2024. This will reduce the cost of monthly mortgage payments and help more Canadians afford to buy a home. This change is expected to unlock the dream of homeownership for more first-time buyers, while also further incentivizing the construction of more new homes. First announced in the federal government's Budget 2024, as of August 1, 2024, first-time homebuyers of newly built homes became eligible for 30-year amortizations on insured mortgages. Previously, the maximum for an insured mortgage was 25 years. However, critics argued that this legislation was too restrictive because it only applied to buyers of new homes. As of December 15, 2024, a 30-year amortization will be available to all first-time home buyers of any kind of home, whether new or resale, as well as to all buyers of newly built homes. Let's break down what a mortgage amortization is. Your mortgage amortization is the amount of time it takes to pay off your mortgage in full. The longer your amortization period, the lower your mortgage payment. Conversely, the shorter your amortization period, the higher your monthly payment. Under current mortgage rules, if you make a down payment of less than 20% of the purchase price of your home, you'll need mortgage default insurance. The maximum amortization for insured mortgages is currently 25 years, unless you are a first-time home buyer purchasing a newly built house. Under the new rules, the maximum amortization will be extended to 30 years. Extending your amortization lowers your mortgage payments. For example, assuming a $450,000 mortgage with a 4.5% interest rate and 5-year term, here's how the monthly payments compare with a 25-year amortization compared to a 30-year amortization. For a 25-year amortization, the monthly payment would be $2,490.63, whereas for a 30-year amortization, the monthly payment would be $2,268.07. Another benefit to lower monthly payments with a longer amortization is that borrowers can qualify for a higher mortgage amount and therefore be able to purchase a more expensive home. When you apply for a mortgage, lenders calculate the maximum payment amount you can afford based on your income and other expenses. A lower mortgage payment potentially means you qualify for a larger loan. According to a September 16, 2024, hot charts released by economists Stéphane Marion, Darren King, and Kyle Doms at the National Bank of Canada, extending the maximum amortization period from 25 to 30 years while opting to keep monthly payments unchanged, will increase the purchasing power of borrowers making a minimum down payment by 9.7%. This ranges from $22,106 in New Brunswick to $51,565 in Ontario. Alternatively, homebuyers could take a more disciplined approach by opting for a 30-year amortization, which would lower their monthly payments by 8.9% for the same home, yielding savings ranging from $107 in New Brunswick to $248 in Ontario. This policy change also has several benefits. All first-time homebuyers are now eligible, not just first-time homebuyers of new builds. All buyers of newly built homes are eligible as well. With a longer amortization period, mortgage payments are 8.9% lower. If mortgage payments stay the same, purchasing power will increase by 9.7% with a longer amortization period, meaning borrowers can afford more home. Developers will be incentivized to build more new homes, which will help tackle the housing crisis due to low supply. However, there are some criticisms of these announced policy changes. While these changes are framed to make housing more affordable, there are some perceived shortcomings to these mortgage reforms, namely that they could actually stimulate too much activity on new builds and drive prices up. Marc Desormeaux, principal economist with Desjardins, mentioned that there is a risk this simply stimulates home buying demand, puts more pressure on prices, and ultimately makes affordability worse over the longer run. In addition, it will take time for developers to build enough new homes to improve supply and make first-time buying more affordable and accessible. What's more, while a longer amortization period makes mortgage payments more affordable, it also greatly increases the interest borrowers pay over the course of their loan. Using that same $450,000 mortgage with a 4.5% interest rate and 5-year term, here's how the interest paid over the entire mortgage compares with a 25-year amortization compared to a 30-year amortization. With a 25-year amortization, the total interest paid would be approximately $297,188.49, whereas with a 30-year amortization, the total interest paid would be approximately $366,829.20. With the longer amortization, a homeowner will pay almost $70,000 more in interest over the 25-year amortization. Given the high cost of housing, particularly in British Columbia and Ontario, where prices over $1 million are not uncommon, legislation that helps first-time homeowners enter the market is welcome news. However, it remains to be seen whether these reforms will actually have the desired effect. Despite national home sales increasing earlier this summer, following the Bank of Canada's first interest rate cut since 2020, the bigger picture shows that Canada's housing market appears to be mostly stuck in a holding pattern, according to the Canadian Real Estate Association's latest report. As a result, many buyers have benefited from increased choice in the market and better negotiating power on prices, leading many properties, including this Toronto home, to be sold well below their original price tags. According to its listing, this 4-bedroom, 5-bathroom home in Toronto's Bedford Park neighborhood boasts over 4,200 square feet of living space, a heated driveway, high ceilings, a media room, a bar, and a gym. The property first sold for $6.8 million in January 2022, at a time when cheaper interest rates boosted demand in the Greater Toronto Area's housing market and contributed to sky-high prices. In August 2024, the home was put back on the market for $645 million and eventually sold for just over $5.9 million, representing a loss of nearly $900,000 compared to its price just 2 years earlier. Plenty of other Ontario homes have sold well below their original prices this year, including a 4-bedroom home in London that was sold at a loss of $650,000 following 4 attempts to sell, as well as a custom-built home in Oshawa that sold at an $800,000 loss. Despite some fledgling signs of life to kick off the long-awaited monetary policy easing cycle, Canadian housing market activity still looks to be stuck in the same holding pattern it's been in all year, said Sean Cathcart, the Canadian Real Estate Association's senior economist, in the association's latest report. That said, with ever more friendly interest rates now all but guaranteed later this year and into 2025, it makes sense that prospective buyers might continue to hold off for improved affordability, especially since prices are still well behaved in most of the country. According to a Toronto Regional Real Estate Board report, home sales throughout the region were down year over year in August 2024, while new listings were up slightly over the same period. The Bank of Canada's rate cut, announced on September 4th, will lead to a further improvement in affordability, especially for those using variable rate mortgages, said Jennifer Pierce, president of the Toronto Regional Real Estate Board. First-time buyers are especially sensitive to changes in borrowing costs. As mortgage rates continue to trend lower this year and next, we should experience an uptick in first-time buying activity, including in the condo market. Greater Toronto Area Realtors reported nearly 5,000 home sales through the Toronto Regional Real Estate Board's MLS system in August 2024, which was down by 5.3% when compared to the 5,251 sales reported in August 2023. The average selling price was also down by a lesser 0.8% compared to August 2023, to $1,074,425. As borrowing costs trend lower over the next year and a half, home buyers will initially benefit from both lower monthly mortgage payments and lower home prices, said Jason Mercer, the Toronto Regional Real Estate Board's chief market analyst. Even as demand picks up, especially in 2025, it will take time for the inventory of listings to be absorbed. Ample choice in the market will help keep price growth moderate, at least in the initial phases of recovery.